and you've all been put on mute as you join the meeting. When we get to the point in the meeting where it's appropriate for questions, what I'd like to ask people to do is to use the chat to raise their questions, and then we can call on people, or we can read them out depending on which works out better. So yes, it's been an interesting few months of 2020, but obviously we're here to look back over 2019, which was a very positive year for us at Co-operative Community Finance. We will do a little bit, I think, just to kind of bring ourselves up to speed, but let's start with the main business. And what I'm going to do is I'm going to hand over to Alan, who is our operations manager, to do the presentation of the accounts for all three businesses. And then I'll take questions on that presentation, and then we'll move into the formal business of the three AGMs, which I'll explain when we get to those stage. So for now, if I can hand over to Al to present the accounts.
That's great. If we could have the next slide, that'd be great. Right, well, hello everyone. Welcome to our first digital AGM. I thought I'd start off really talking about the partnerships we have, because really, you know, our success is really the sum of the partners that we have. We have different partnerships with different organisations. Some of them fund us, some of them we do work for. All of them, oops, that's disappeared there. So for example, you know, we work with Big Issue and Radical Roots. You know, we have a back office function. If we also look at we work closely with Plunkett, more recently on More Than a Pub, which has been funded by Power to Change, but previously with Plunkett on the Village Core programme, very successful. Also doing work with social investment business. Esme Fairbairn have helped fund some of our projects in the past. And also we're running the Co-op Loan Fund, so doing the full fund management for them. So there's lots of organisations that really help with our success and are partners to our success. If we now look at lending for last year. Next slide, please. Yeah, so I mean, yeah, it keeps going up, doesn't it? Which is really nice to see. I think, I mean, we're just below 25 million there in terms of the history. This is all our lending, so all the lending decisions we're making for our own funds and some of the funds we manage. So we're just under 25 million there. We had a lot of pipeline from last year. I'll talk about the lending performance on the different companies a bit later. However, that pipeline came through in the first quarter this year. So I can announce that we've gone through 25 million already this year in terms of cumulative lending. To put this in context, when we started in 1973, we lent nothing. And the following year, we lent £1,000. So I think we've come a long way. Yeah, it's a measure of our success really, that graph just keeps on going up. Let's have a look now at the group accounts. So these group accounts, they're for ICOF Ltd and for ICOFplc. ICOFplc is a wholly owned subsidiary of ICOF Ltd. Turnover was up on last year, so 316k. If we look at turnover, we have different income streams. So we have the loan interest from the lending itself. We have fund management, likes of running Co-op Loan Fund, and consultancy with Co-op Foundation, arrangement fees again from the lending, and the back office, as I previously discussed, that we're doing for Big Issue Invest and for Radical Roots. Expenses were 353k. You can see the largest expense we have is wages at 172. They were lower than last year. We didn't have any lending losses in 2019. It's been a bit of a lumpy few years, but we had a clear year last year, and we did have lending losses in 2018. Other income at 207, very high. That includes the final tranche of the More Than a Pub 1 programme. and also within that we have some investment income and bank interest income. So that gave the group a total comprehensive income of 170k for the year. That was compared to 47k the previous year. Could I have the next slide, please? So if we go on then to look at PLC, is contained within the consolidated accounts that I've just presented. Turnover was down on 2018, and again, if we look at what makes up that turnover in PLC, it's loan interest from the lending, arrangement fees from the lending, and dividends from some investments we have in retail societies. Within Limited, there were low levels of lending. Brexit uncertainty was playing its part. That's all been shifted over now into this year. So lending was down. We did find within the types of businesses that the PLC would lend to, there was a reluctance to make business decisions because of the uncertainty over Brexit. That said, that pipeline has come through into 2020. And as I said, that's helped us push us over the 25 million line for combined lending for the entire history of the organisation. Expenses were lower, obviously less activity lending, then the expenses were lower. So those management fees were lower and interest write-off from 2018. So whilst it made an operational profit, after FRS costs of 44k, it made a loss of 20. I would explain that FRS costs later on when we look at the balance sheets on PLC, which is now. So looking at the balance sheets, if you look at group, if you look at lending, loan balances were lower. As I previously discussed, there was lower lending with the Brexit uncertainty, but the pipeline has come through. So 2020, we should see that much improved. Cash was higher because obviously if you're not lending, then the money stays in the bank. So at 2.7 million. And that meant that the balance sheet for group stood at 2.475 million compared to 2.305. Big part of that was 170k total comprehensive income seen in group. If we look at the PLC balance sheet, as above with lending really lower, and then cash higher because there's more cash in the bank. If you look at the capital reserve is an amortized cost of the payment of share interest on PLC shares, that FRS. FRS means that we have to model as if we are paying dividend over the 10 years of the PLC shares. It means in the beginning you get a big gain, which creates the capital reserve, and then you have to write that off over 10 years. So that continues to go down. You can see 478,000 in 2018, down to 434,000. However, there is an operational profit element within the P&L, and then that goes into the profit and loss. As previously discussed, we've had some heavy losses in 2018, which is why the profit and loss is minus 110 in 2018, but the operational profit has improved that. So whilst the bottom line is giving us a loss of 20, part of that loss goes to the capital reserve, and there is an element of operational profit which improves the profit and loss. Hence the improvement in the loss reserve to 86,155. So that gave net asset position on PLC of 348,000. If we move now onto ICC. ICC's really kind of blossomed really the last couple of years. Even though it's fairly low activity, financially it's in good shape. Turnover was 32k, which was more than last year. We're seeing increase in demand from community businesses, cooperative community businesses. That income comprised loan interest from the lending and arrangement fees, and also dividends. As before, we have some investments in some of the retail societies. Expenses were higher than last year, but lower as a percentage of turnover, so just really reflecting the activity and the management charges. Other income included dividend and interest, so that gave a profit after tax of 8k for ICC. This was double the profit after tax of last year. Last year we paid, for the first time in 11 years, we paid interest on members' investments of 0.25%, and we're delighted that at this AGM later on under the ICC business we will be proposing another interest payment, and higher one indeed, than last year. And then just looking at the balance sheets on ICC. Lovely, thank you very much. So loan balance is up. Cash higher. I mean, it's I've been saying with the other companies that the lending is down and cash is up. We did actually have a significant investment into ICC last year. So not only was lending up, so the loans at 898,000 compared to just over 800,000 last year. Cash was also up at 328,000, and net assets at 978, significantly up, but then reflecting that large investment that we had last year. And that's it really for all the three companies. So does anyone have any questions on the accounts? I think you can use the chat button, and then we might bring you in, but I'll leave it to Ian Rothwell, who's doing the technical side of things, to monitor your chat.
Thank you very much, Al. Whilst we're waiting to see if anyone's got any questions they want to put in, I'd just like to take this opportunity on behalf of the board to say thank you very much to the staff for, as you can see from Al's presentation, a very positive result from 2019, but also to thank them for the immense amount of work they've done in this year in incredibly difficult circumstances. As you can imagine, as with many other businesses, our staff have been working from home, and whilst our business is one of those that is not directly affected by the COVID crisis, there has been a lot of impact on the people that we work with, and a lot of work to support businesses by offering them changed arrangements on their loans, and offering people payment holidays where necessary in order to support them to continue with their vital businesses. Right, so we have a question from Richard about the historic loan balances. So Al, do you want to answer that one?
Yeah, happy to ask that. I wouldn't say it's levelling off. There certainly at the beginning of COVID this year, certainly demand dried up. People, businesses, co-ops, did not want our sort of loan product. What they wanted was grants, or needed, just to survive. So really, certainly regarding this year, we had a lot of pipeline through from last year. So it's really difficult. We virtually lent as much in the first 3 months of this year than we did in all of last year, and then COVID hit. So we dealt with the pipeline, but certainly demand has been lower. I mean, I don't know if Ian wants to come in on this.
Yeah.
As the investment officer.
It's been a very strange couple of years. Demand sort of dropped because of uncertainty around Brexit, and then just as it was picking up again, COVID hit us. We've actually got sort of quite a few loans that we've put on hold due to COVID, due to the lockdown, because they were to pubs, working men's clubs, garden nursery centre. So we've got sort of quite a lot backed up, if you like, that once everyone's ready, we'll be able to then release. And lending has been quite slow since the whole COVID, in terms of applications since COVID-19. So it's been sort of very up and down, and it's impossible to look at a trend without something unusual happening over the last sort of few years. So I think lending is holding up, but with the different products that are around at the minute in terms of the bank, the government's bounce back loan, which is such a good deal. No one's wanting a sort of straight loan at the minute, and also no one's wanting a sort of commercial loan with all this uncertainty ahead.